All right, what is up, bro?
How's it going,
Episode
man?
it's going good. Episode 26.
Okay, moving right
Yeah.
along.
How are you doing today?
I'm doing good. Enjoying this Monday. It's been a little eventful. We were on a call with our agents that are we're trying to sell that property in the Heights on Studewood. So
Yeah.
we had someone talking about an offer over the weekend. So we got together today and just kind of game planned with communicating back with that buyer's agent and trying to kind of coax a real offer out of them if they really
Yeah.
want an offer. So that's pretty much what my morning was like, and had lunch with my wife, and now I'm here.
Life is good. Yeah. Today's a normal day for us. We just worked, got on the phones, and my son is off of school today.
Yeah, Julia's off today. I think it's Indigenous Peoples Day. So
Yeah. Yeah. So that's good. So I have no reason not to work. Today, we had a great weekend. Went to Austin for Empire Builders with Alicia Shepard, who was a guest on the show a couple of weeks ago. If you missed that episode, guess what? You can easily go back. We're on YouTube. We are on Spotify. We'll be on Apple, iTunes podcast by the end of the week. We'll be on there. So very fun. We're going back to the basics again. So this quarter Q4, which is in my mind, we're already in 2026. I think the things that we do, the decisions we make, this is really impacting how we start the year off. It really starts. We call it real estate New Year's.
okay,
So where was I going with that? This last quarter in REI 101, and this is episode 26. So we have enough content right now for to write a book. So maybe something we can we can think about. But we're going to be talking about um, real estate investing basics again. So we're going to be revisiting that one. So just to kind of give you an overview of our plan for the rest of the year. We we're going to be talking about deal or no deal, how, when to walk away or when to fight for a deal. Albert, you're right in the thick of it negotiating. I'm in multiple negotiations right now, and all of them are just kind of this stuck, stuck, trying to get things through right now. So sellers are too high, buyers are too low. So we're going to be talking today about the BRRRR method, math and mechanics, when to buy, when to hold, when to let go. Um, then we're going to talk more about flipping versus holding, and we're going to look at multiple asset types. So we're going to be looking more at multifamily as well as single family. And then October 27th, you want to stay tuned to this. We'll have a lot of updates on STRs, Airbnbs, VRBOs. Albert and I have been talking about pad splits and what's trending and what's here for the moment and what's here to stay. So it's really we have a lot of people kind of throwing their hands up in the air. So that'll be our October focus. Looking at that, should we do long term, midterm, short term hold,
yeah.
and
I
then
think I think both sides of that conversation is kind of polarizing, especially here on the Gulf Coast. You've got
exactly.
people who love long-term rentals and really hate short-term rentals, and
Hmm.
you've got people on the other opposite on the opposite end of that spectrum, which they really love long-term and mid-term rentals and really can't see the value in long-term rentals. So
Yeah,
it's be a
yeah.
good discussion.
It will be a good discussion, but in my opinion, at the end of the day, you got to let the data do the talking. So people do have their feelings about it, and I think that this is a time for buyers to really pay attention to emotional sellers, um, because there are a lot of sellers out there they're expecting a lot more for the properties than their properties are probably worth,
Oh yeah.
and it's it's pissing a lot of people off. A lot of people are getting upset and frustrated, and I think we have a lot of sellers that are going through the stages of grief right now. First it was denial, and now they're starting to move toward acceptance.
Yeah.
Pretty soon they'll start making deals with God to get rid of the properties they own.
Yeah.
So all right, Burr. So let's talk about the Burr method. And this really isn't like a an all-inclusive specific thing. This really includes a lot of different. It's like a smorgasbord. It's like a buffet of strategies kind of put together, and you can tweak this. But what's the Burr method, Albert?
So the BRRRR method is when you're gonna buy, rehab, rent, refinance, and repeat. So
Hmm.
the key for me in this particular acronym is the rehab. Is
Yeah.
that you are looking for properties that are fixer-up properties. So you don't necessarily apply this. I mean, you can, but you wouldn't necessarily apply this to like a turnkey property. It's
Right.
really something that you can rehab, right, and add value to it. So you're going to buy it at a
Hmm.
discount rate. We're going to talk about some of those things here. Yeah, but that's what the Burr method is. Kind of made a really big, like Bigger Pockets made it really popular. Lots of books out there on the Burr method. I would even say some people say the Burr method is dead, but we're going to talk about that a little bit today. So
I don't think the Burr method is dead. I think the Burr method looks different in
yeah,
different markets. Because essentially, number one, you got to buy it right. You got to buy it at a discount. Number two,
yes,
you've got to. The rehab is where a lot of the opportunity historically is. That may not be. Um, it may not. Sometimes it's I would say an opportunity, and sometimes it's just necessary. You just got to rehab it.
yes, yeah.
So sometimes it's part of the strategy, and sometimes it's just something you have to do. But
Yeah, I mean, you mentioned though just a second ago, you have to buy it at the right price.
yeah,
Yeah,
so number one, buy right. A good there's a couple different targets that we can use, and if you have any ideas or you have any metrics that you look at and you're on the call right now, feel free to leave a message in the chat. But one of the first things that investors, the number they hear is that 75% rule.
or even it's a 70% rule too.
Yeah. And
It's
I
hard to
haven't
beat.
I haven't heard anybody say anything less than 70%, but sometimes they'll say
Mhm.
80%. As a real estate agent myself, I think 80% oftentimes works, and we can talk about that, but 75 is a good starting point. So what does that mean? 75%. So let's break that down so everybody understands.
Yeah, I mean, so really what you want to do is you want to buy that property that's really kind of 70 to 75% of what that after repair value is. So you're either going to run comps on your own or work with an agent like Austin to help you kind of look for comparable properties within a certain geographic
You're
area
either going to
using
run
around
comps on
half
your
mile.
own
Or work with an agent like Austin to help you kind of look for comparable properties. That's weird. Yeah. Anyway, work with Austin, you look for comparables in an area like about half mile out, and you want to look at properties that are fixed up that are
Hmm.
very comparable to your property, and then you're going to come up with a value there. So let's just say 200,000 is where you're at.
Yeah.
So you want to buy this property for a discount, and you want
Hmm.
that discount to be 70 to 75% off when you include the repairs as well, right? So it's like the purchase price plus the renovation costs. You want to be 70 to 75%. And we're going to talk, like when we get to the refinance part, we're going to talk about why that 70 to 75% is really important, why that
Right.
number is important. But that's what I'm looking for is I'm looking for single family, multifamily, whatever it is. How much value can I add to this property by fixing it up or adding square footage or building an ADU or things
Yeah.
like that where I can add this value and get to that top of market value when I'm done with this project.
Exactly. And it's critical to have some pretty extensive conversations with a couple different people. So obviously, first thing I like to tell people is don't start getting creative too quick. So you're going to go to your agent, you're going to say, "Show me the comps."
Mhm.
And a lot of times we'll run these comparable reports and the system will automatically put on based on the average price per square foot or based on these properties, this one should be worth $240,000. That's the easiest way to get into a tremendous amount of trouble is just by taking a bunch of random properties and averaging them together and then coming up with a number. That's not how it works. So you hit the nail on the head. So which you have to look objectively at everything that has moved. I would say preferably within a 6 month time frame.
Hmm.
Um, but in some cases, you need to go back 12 months. You need to look at the map. You need to really pay attention to the neighborhood. So, because you need to look at the boundaries. And when I talk
Hmm.
about boundaries, first of all, some agents are just going to put the name of a city. If you are looking at homes in the city of Houston under $250,000, you're going to get so many different things that don't make sense because the city of Houston looks like just a huge spider web. It doesn't make sense. So never ever use city limits when you're looking at those comps.
Hmm.
I prefer to use school districts or even better elementary schools. If you want to go real tight, the elementary school boundary, and people are like, well, I'm not going to send my kids to school there. That's not the point. The elementary school, um, one one elementary school may be 10 times more desirable than the elementary school next to it, and for that reason, there may be a 20 or $30,000 average difference in the sale of homes between two streets. In some cases, between two neighbors on the same street, and
Hmm.
we've seen that. That's in League City, that's in Marbella, that's all over Houston, that's in Siena, where you have
Hmm.
a an elementary school boundary going in between two neighbors' homes.
Wow.
So if one is lower rated and the other is a high rated, that will directly impact the value of the home. When it comes to the rehab, this is critical too, because if you're in, let's say you're in a lower income or you're in an older neighborhood, and the most expensive 2,000 square foot home sold, and it had, the late 1990s yellow oak, and it had floors that hadn't been updated, and it had yellow paint or wallpaper, but it's in good condition. The owners took great care of it, but it's just outdated.
Hmm.
But if you look at that house and say nothing sold for more than this, that's your baseline.
Yeah.
That's your that's your reference point. And so when it comes to buy right, you can't just mix everything together and say this is the value of your property. You have to find a reference point. And Albert, as you said, in some cases, if you some cases you may have an opportunity by expanding the house.
Right.
Now, how would you know that? You would know that by looking and saying, okay, here's all the 3 bedroom houses, here's all the 4 bedroom houses. And in some neighborhoods, when you compare the 3 bedroom homes to the 4 bedroom homes, by the way, your real estate agent should be able to do this at a high
Hmm.
level.
Hmm.
When you compare the 3 bedroom homes to the 4 bedroom homes, you should see a major discrepancy. It could be a 40, 50, $60,000 discrepancy.
Right.
But in some neighborhoods, you're going to compare the 3 bedroom homes to the 4 bedroom homes, and there'll be no difference.
Yeah.
You may resegment it based on the amount of square foot, and sometimes the bedroom makes a bigger difference, and sometimes adding the extra square foot makes a difference, and sometimes you can't tell because it's actually the bathrooms.
Hmm.
So we did this in Laporte. We discovered this. There was a house we sold in Laporte for a client, and every there was a pattern of 3 bedroom, 1 bathroom houses, and we compared that to the 3 bedroom, one and a half, or the 3 bedroom, 2 bath houses, and there was a night and day difference. Those 3 bed, 1 bath house were so the average was like 50 or $60,000
Wow.
different. So we
Wow.
figured, hey, put $25,000 into it. Find a way to add a master bathroom, and then
Hmm.
that's doubling your money right there. But
Yeah.
again, the only way you can see that is if you understand what factors, and it's not always the same thing. Some people will say, well, what about swimming pools? Do swimming pools add the value? Well, in some neighborhoods, it helps. It it never makes sense from from an investor perspective to add a pool. But when you're looking
Right.
at homes that have pools in it,
Yeah.
there are some neighborhoods in Houston that if you look at the average home with a pool and the average home without a pool, the house without a pool sells for more money.
Uh-huh.
So again, it's just looking at that neighborhood, looking at the different things are going to different factors are going to mean different things to different people in different markets.
Exactly.
So I know
Yeah.
that was a lot, but and then
No.
once you have that figured out and you decide, okay, I do want to add a bathroom or I do want to add a bedroom or add some square footage, or you may want to fill in the swimming pool and put
Yeah.
put grass over it.
Yeah.
You
One
know,
of the things that we do, like when we're looking for properties, especially like on the even the small multis, like two, threes, and fours, is we're looking for properties that have like 5,000 square foot or larger lots.
yeah,
Because then there may be an opportunity there.
yeah,
We can add like 500 square feet or build like an ADU or something like that in the back. I mean, there's really no zoning laws in Houston, so
yeah.
you can do a lot in Houston. That can work for you and against you, but um, we look at lots that are larger. We work with agents too, and myself, I've got access to the MLS. So it's just kind of a toggle, when
Hmm.
I'm looking for comp properties, Austin, I'm going like 250 square feet bigger or smaller.
Yeah,
I'll look at that and then I'll play around. I was like, okay, what if I was like 500 square feet bigger,
right.
than where I'm at now? Does that take me into like another price, another
Yeah,
tier? You know what I mean? And that's when I'm like, okay, great. Maybe we add 500 square feet to this and we can add another $80,000 to that ARV, but it's only going to cost us 20 grand, to add that
absolutely.
square footage.
Absolutely. And you
Yeah,
got to be the when it comes to that, you got to be careful too that you don't just rely on the price per square foot because on
right.
average, um, everybody needs to understand that the price per square foot on average will decrease the larger the
Yes.
house gets. So
Yeah.
again, it's more like a case by case
Yeah.
basis. You have to find those like reference
That
points.
that's where I see, we're kind of going on a tangent here too. I see where investors get themselves in trouble especially when they're working with a wholesaler. Because wholesalers will be marketing a 1,500 square foot home, right? And they'll have comps that are 800 square feet,
Hmm.
or 900 square feet.
Right.
And then they'll put that average price per square foot on that smaller house, which is much higher, and they'll apply it to a 1,500 square foot home and say, hey, this home is worth $400,000, and I'm only selling it to you for
Yeah.
300, for 250, right? So be careful. Yeah, you're right,
I think
100%.
I think that piece of advice right there is one of the easiest ways that an inexperienced investor can shoot themselves in the foot
Hmm.
and lose a lot of money.
Yeah.
Because when you hear people, because you hear that in commercial, that's all we hear all day, every day. Price per square foot, price per square foot, price per square foot. But in residential, and a little bit in commercial, but in residential, price per square foot is the byproduct of about 10 or 20 other factors and variables that go into play. So that's a huge soapbox for me because I've seen that's one of the reasons why a lot of these big houses are way overpriced because
Hmm.
they t- they took the price per square foot of all the average and smaller homes and they applied it to the big home and now they're 60, 80, $100,000 overpriced so they don't
Yeah.
understand why.
Yeah.
It just doesn't work that
100%.
way.
All
Okay.
right.
We could camp out on this by the rehab number two, rehab to force appreciation. Now, one mistake that I have seen over and over again the past 24 months is investors going way over budget on the rehab. It's
Mhm.
more expensive now than it was 5 years ago.
Oh,
Are
yeah.
are you seeing this too?
Yes. Yeah, definitely seeing it. And like everything from materials have gone up. I mean, labor was spiked. I mean, I'm saying lumber was spiked at a certain point in time. I think in 2022-ish, it was spiked pretty high. That's kind of come back down, from the clouds. So that's kind of come back down, but still, windows, siding, roofing materials, electric, materials, HVACs. HVACs have stayed kind of steady, surprisingly, but overall, the cost for materials has gone up. The cost for labor has gone up, and honestly, I anticipate it to go up even more as well.
Hmm.
With kind of that labor market, we're going to be having some shortages,
Yeah.
if things continue to go the way they've been going with this
Hmm.
direction, over the past year. So, without really going into detail, but that can get tough for general contractors, subcontractors, finding people out there, laborers and people like that to come and work for you.
Yeah.
The cost of labor is just going to go up, and that's going to drive up the cost of housing as well. It's going to price out a lot of smaller investors. We can go on another soapbox discussion there, but
Another problem that's going to create, it's going to delay rehab times. It's going to delay
yes.
these projects.
Yeah. And what we need right now is, well, Texas, maybe not so much. I mean, we have so much we can talk about on this call. I wish it was longer sometimes, but when we talk about inventory, right, you're talking about delays.
Hmm.
Delays kind of, okay, well then houses aren't being rehabbed as fast, aren't being built, or apartments aren't being built as fast.
Hmm.
But I just heard a podcast saying that Texas is actually starting to slow down on builds because of
Yeah.
the oversupply.
Yeah.
So now we're starting to slow down and kind of turning that knob in the opposite direction. I'm like, man, we turn it too far, right? And we
Yeah.
stop building, and then it never really seems to equalize, right? It
Right.
just always seems to jump from one extreme to the other.
Yeah. It's
Yeah.
interesting you brought that up because I did a Twitch stream last week on multifamily, and you're 100% correct. October, so the market reports come out every quarter on CoStar. And if you go back and look at the market reports from Q2, um, things were there was a surplus in deliverables. Like you said, the data backs that up on all different asset types: industrial, retail, multifamily, office. Um, Things are definitely they were being built faster, and now construction is slowing down,
Yeah.
which is going to be interesting in the next 6 months to see just that factor is construction slowing down if demand's going to go up, and we may see
Right.
those cap rates start to come down, and so there's a lot to it. So
Hmm.
um, other things to keep in mind in rehab is understanding that the cost of labor is going to fluctuate, the cost of materials are fluctuating. But also another factor that I think a lot of investors tend to neglect, and I want to show you. I'm going to share my screen. Well, I don't need to share my screen, but if I went back before the episode, I went back to Matrix, and I did this last week too, and I looked at the average sales price of a single family home in the Houston market.
Hmm.
And I first did this on multifamily, 16 units and above. Going back 10 years, um, they've appreciated. So they're going up in value. Um, Single family homes, not as much in the last 3 years. So when you look at this, just the last 3 years, the average price, sales price of a single family home in Houston has actually lost 1.2% of its value every year for the last 3 years. So in there's multiple dimensions of trends that I think are critical to understand. So if you've ever heard the James McDonald story, how he bought a house and took him a year to rehab it, and that year made him $100,000. Well, that was
Hmm.
back in 2021.
Yeah.
So you got to look at those like 12-month and three-year trends, and you can see like right now values are dropping. So if you think that okay, I'm going to buy this house and it's going to be worth $250,000, well, we're in a downtrend. You need a instead of 250,000, it may be worth 240 by the time you're done with it if you take too long. However, this is where the Burr method is like saving grace in this industry. In a 5 year period, just the 5 year period from 2020 to 2025, it's increased by 5.5%. In a 10 year period, it's increased by 3.5%. But going back, since we have data on Matrix and HAR going back to 2006, it's consistently averaged 4.7% a year. So it's been historically, we know that appreciation in single family homes have averaged 4.7. Multifamily is a lot higher than
Mm.
single family homes. Not, not to say that you need to stop sell all your single family homes and to buy an apartment complex, but I think that's probably something that everybody should consider. But what was the point of all that? Time.
Yeah.
Time kills deals. So the rehab time, you got to have contractors that, like Javier and Scott, that we've had on the show. They're not going to play around, and if there's something they don't specialize in, they'll tell you right away. You can find somebody else to take over that part of the job.
Yeah. Yeah.
So
Awesome.
number three, my other R's. So we got to rent it. This
Hmm.
means going back to the comparables before you buy it, you need to know what those rent comps look like.
Hmm.
And just like the sales trends, the good investors not just going to know the comps, they're going to know the trends in that market.
Yeah. I mean, like really, we talked about this on other calls when we were talking about exit strategies, Austin, is when you're looking at these properties and you're underwriting these properties, you're kind of looking at, how cheap or how much of a discount you can buy this property for. All right. And
Yeah.
also, what am I going to be able to refinance it for? Right. And that refinance number, right, that's your appraised value, that's your after repair value. Okay.
Hmm.
So you're looking at the comps for that, but you're also talking to lenders in the beginning of the process, not the end of the process. You're talking to lenders in the beginning of this process, asking them, hey, what are current interest rates, right? So typically they don't fluctuate too much within a 6 month period. Can you get a rate lock,
Hmm.
right? Like you should already be talking with a lender and maybe
Yes.
even be locking down your 30-year, like your long-term financing on this. So then you have an idea. What's your mortgage going to look like?
Hmm.
Is it going to be about $1,400? Is it going to be $1,500? Because if you're only running rental comps and you haven't really talked to a lender about your refinance, right? And your rental comps are saying you can get $1,500 rent, you're like, okay, cool, but you don't really know what you're going to be able to refinance this for.
Yeah.
And by the time you're done with this, you go refinance this and your mortgage is now $1,700 a month,
Yeah.
right? Now you're losing cash, every month on this deal, you know?
Yeah.
So that is one thing that's super important that I think people should pay attention to when they're underwriting these deals is not only what you buy it, the discount you buy it for, but also what are you going to be able to refinance this for, and then all the numbers in between.
Exactly. So if we are using hard money or we're using private money to purchase and rehab the project, typically those rates are going to be much higher than
Hmm.
like a 30-year conventional mortgage. So yeah, you want to know while you are, you know, while you're in the rehab phase, what is your mortgage going to be? Because you're operating at a loss until you can get a tenant into the
Right.
property. You're
Hmm.
operating at a loss. So you need to factor that. So it's not just what's my down payment, what's my rehab cost, but you also got to factor in like you're going to pay taxes, you're going to pay insurance, you got all
Hmm.
these different holding costs, and you're not offsetting those costs with any income at that
Right.
time.
Right.
And then like you said, get pre-approved first. And it's a good
Hmm.
idea before you even purchase the property with your hard money lender to have your conventional lender, your traditional lender, run it and give you an estimate. Like you do need to know that number. And
Yeah.
it's very surprising how many people get into this and they don't know that number.
Yeah.
It's like, dude, like you should
I mean,
know.
it's like you're shooting at a target with a blindfold on.
Yeah.
Like you're just kind of shooting in the general direction and hope you hit a bullseye or hope you even hit the target.
Yeah.
You have to know that number.
I think a lot of us in the real estate world, we're coming out of a very forgiving market,
Hmm.
and wishful thinking has really paid off well for a lot of us. It's just not, it doesn't work anymore. I
No.
mean, That ship has sailed.
No.
And it's okay because when there's blood in the street, that's when that's when the biggest opportunities are, right?
Yeah.
So,
Yeah. Yeah, so you're looking at the rental comps, right? Trying to understand that. You're looking at your refinance, so getting your long-term financing in place. And typically they're going to lend to you at like 70 to 75% of that loan of that appraised value.
yeah.
Typically it's about 75% for an investment property. And that's why that discount that we talked about in the beginning is so important.
Yeah.
You know, if you can get it at 70% or less, that then you're going to go get this refinanced for 5% more than what you put into it or what you bought the property for and rehabbed it
Yeah.
for. So you can probably recoup a lot of your holding costs, you know, maybe some of your overages,
Hmm.
okay, things like that, and potentially have a perfect BRRRR. Like
Yeah.
that perfect BRRRR is you go refinance at 75% and you get all of your cash out. That's only happened to me once, by the way, and we have I think 6 BRRRRs, so it's only happened once. Every other deal we've left cash in
Yeah.
the deal, you know, and that's kind of your investment now, right? Like let's say
Hmm.
you have to leave 10K in the deal, right? But you're gonna cash flow $200 a month, right? That's what $2,400 a year.
Yeah.
So your return on investment is 24%, right?
In addition to the comps, I would ask my agent for um, trend reports too. So let me explain.
Mm-hmm.
So if you look at a zip code, I'll pick mine 77505, and you see, for 2,000 square foot homes, give or take 250 square feet, you can create a report. Okay, show me my average sales price of houses between 1750 and 2250
Mm-hmm.
in this zip code. I want to see over a 10-year period, over a 20-year period, what is my average appreciation? So say we're at 4.7% appreciation over the last 20 years. You can do the same for your rental comps. So a 2,000 square foot house right now could probably rent out for like $2,400. How much has the rental data appreciated? Is it appreciation? Is it trending at the same trend line that your sales comps are? Is it a Are you getting 4.7% more in rental income than you were a year ago? And has that been consistent over the past 19 years? Because what you may find in some markets, the 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 rental appreciation is slowing down, and that's not something that you can see just by looking at the comps.
Mm.
You have to
Okay.
go back to look at historical trends, but you also may see like, hey, like in some markets, the rental's been averaging 6% increases over the past 20 years.
Mm.
So those are definitely things to really take into consideration, because that might
Yeah.
tell you if your rental appreciation is trending faster than your value appreciation, you may want to hold on to that puppy.
Yeah.
It's just going to get better.
Oh yeah, for sure.
All right, so rent it out, refinance it, and
You
then
pull as much money out, and if you can pull it all out, then you have cash
to do.
for the next deal to repeat.
Okay, so how soon do you pull that money out? Is it the first time you refinance it, or do you wait and refinance it after it appreciates a little bit? Get some equity into it.
So, I mean, there's just different schools on this particular question. How I look at it, Austin, is I believe that I can make that equity work harder for me outside of like pulling it out of the property instead of waiting. So if I have an opportunity as soon as possible to pull some equity out of that property and still cash flow, right? Have a mortgage that I'm still cash flowing on, I'm gonna pull as much as I can out. I'm going
Hmm.
max amount, right? As long as I can still cash flow, I'm going max amount because I can take that equity and deploy it somewhere else and get a much higher return
Hmm.
on that investment instead of this natural, appreciation that's going to happen with the market.
Right.
So, I mean, because in all honesty, in some markets, like you mentioned before, some of the housing pricing has gone down
Yeah.
year over year, 1 to 1.5%.
Yeah.
You know what I mean? So if I don't pull that out now, right, I may have to wait 5 years for this market to rebound before the house appreciates back to where it should be before I can pull cash out. So to
Right.
answer that question, I'm pulling cash out as much as I can to remain, cash flow positive as early as possible.
Yeah, and I know this is, anti Dave Ramsey, but the truth is the less money you have in it, the greater return on your investment when it comes to the appreciation,
Oh yeah,
right?
exactly. Yep.
So, and we know the appreciation is one of the most consistent things financially in the history of the world is real estate appreciation. It's it's been consistent. Single family homes are consistent at 4.7% all time. I mean, that's an indisputable fact right there. So
Yeah.
yeah, so if you can pull that money out, do it again, great. Keep it in real estate. There are a lot. We won't get into the weeds on this, but I'm looking into self-directed IRAs. You can do all that inside a completely tax-deferred self-directed IRA.
Hmm.
Incredible retirement plan and incredible way to play this game without giving all your capital gains
Yes.
to the man.
Yeah.
So appreciation trends nationally, single family homes have risen about 4 to 5% annually
Like you said.
over the last decade. That's nationally. Houston's up there on the little higher end of that too, and I
Uh-huh.
would I would expect Houston to continue in that trend. In Texas, in the Sun Belt, appreciation rates have been stronger. There are segmented markets, and by the way, when I say Houston, that's everything in Houston. Take a look at Harris County, or take a look at the specific zip codes. Even look at like go micro with that approach. Don't just say Houston's 4.7. I'll get 4.7. Like you may be in a market where everything's going down in value for whatever reason, or you may be in a sub market where maybe there's a celebrity that lives down the street from you and everybody's properties have been averaging 10% a year. Who
Yeah.
knows? So there's small other things. You may be on one side of Deer Park, Pasadena, and LaPorte that's closer to the plants. Those haven't been
Right.
appreciated as fast.
Right.
So even with the slower growth in the last year to 3 years, single family homes, they remain stable. And every metric that I measure has been negative except for the fact that the values still continue to rise.
Yeah.
Interest rates are high, inventory is high, days on the market are off the charts.
Hmm.
We never had 40,000 units on the market, but for some reason they're still selling for more money, which is just doesn't make sense. So,
Yeah.
um, in the
Uh,
multifamily space, we're seeing double or triple those appreciation rates in some
hmm
cases, especially with the bigger properties. Um, the smaller ones are getting about 3, 4, or 5%. The bigger ones are getting 10+%. So, anything else about that? Any other market context or any market factors that you think play a role
Well,
in?
I mean, like what we're seeing with the average DSCR, and in these investor loans. I remember when rates just skyrocketed in 2022, and that happened to be a time when we were refinancing three of our BRRRRs. One of them was refinanced at 8%.
Yeah.
I mean, and one's refinanced at 5.5%, and one's refinanced at 8%.
Mm.
And that's how fast interest rates went up in that short period of time.
Oop, I muted you. Sorry about that. Um,
You
were you,
know, so,
are you able to go back and refinance that, or you still
yeah,
need
yeah,
more
we can go
time?
back and refinance. We're waiting for the prepayment period to get through, and that's fine, right? That gives us time to. I mean, the properties are stabilized, right? We've got long-term tenants in there, and we're in for the long haul. You have to be in for the long haul if you're going to make money in
Yeah.
this industry. Like if you're in and out, just like the stock market, you're going to end up losing money over the long term. But seeing it now, like 6.75 to 7.25 range for investor loans is right about kind of average where it's been for a while.
Yeah.
Hoping it goes down. Like I don't really think investor loans will go sub six. Conventional loans, definitely I think have there is opportunity there for the next 6 to 18 months for those to drop.
Yeah,
Will we ever see 3%? No. I hope we don't see 3% interest again because we may be in a recession at that point
I
in time.
agree with you. They
But
need
yeah,
to just not be crazy.
yeah, that's kind of my insights there. I really want to talk about like the pros and cons though of this BRRRR strategy.
Yeah,
You know?
let's hit that. We got about 5 minutes. So
Yeah, yeah.
you want to
You
start
know,
with you want to start with the pros or start with the cons?
No, I'll start with the pros. I like to start with the good, and then we'll finish with the bad, and then we'll send everybody off for lunch. But like for me, remember I told you like we had one perfect burr. It was actually more than perfect. Like
Hmm.
it was a burr that we were refinanced, and we got 20K back out. Not only did we get our cash out, we got 20K more out. And our mortgage payment was a little bit high, but we were like, fine, and we're cash flow even, maybe cash flow positive just a
Yeah.
little bit there. But I redeployed that $20,000 somewhere else and made a much better return on another property. That's appreciating.
What?
That next property added $125,000 to my net worth.
So other than the lower interest rates, it sounds like you bought it at below the 75% rule.
Oh,
Probably
much lower. Yeah, much lower. I think the ARV at the time was maybe 220-ish. We bought the property for $70,000.
that will help. And you
Yeah,
stay you
and
stayed under
then
budget with your rehab, I'm
yeah,
sure.
and then I think we put like maybe 75,000 into it. So we were still under that 70% rule.
Okay.
And I think it appraised for like close to $300,000 by the time we were done.
Uh,
Yeah.
yeah,
So yeah, so the appraisal went up, and then because of that, right, we were able to pull more money out. Yeah. So that's definitely, if you can do that, you can recycle. I mean, I tell this story to a lot of people. We started with about 50K, Austin,
hmm.
and we have $3 million in single family homes right now, right? And that attribute that a lot to this BRRRR strategy.
Good. There you go.
Yeah.
What else you got for pros?
Yeah, so well, you've got, of course, of just holding and owning real estate, right? Flipping is a job, wholesaling is a job, owning real estate is how you build long-term wealth, right? So holding on to these properties, which is what we're doing, is how we're building long-term wealth as they appreciate over time, right? The tenants, the renters, the Airbnb guests, they're paying down the debt, so I don't have 11 mortgages that I have to budget for. All of my renters and tenants and
Yeah.
guests are paying that debt down, right? I think the biggest overlooked advantage, especially for newbie investors, is tax advantages.
Yeah.
Tax advantages, especially if you still have your W-2 job or your
Yeah.
spouse, right, has a W-2 job and they're a high income earner. So
Hmm.
when you're doing things like short-term rentals, mid-term rentals, things like that, is you can do this bonus depreciation, which
Yeah.
now has been reinstated to 100%. You can basically depreciate the property in much larger chunks over shorter periods of time instead of 27 and a half
Yeah.
years, which is for single family homes. Like you can take a lot of your depreciation within the first 5 years,
We've
you know.
we've got
And there's some
we've got
other
to get a
tax,
tax
yeah,
accountant on the show because we
yeah.
this is like
Now
the
that's good. Yeah, and I have a really good suggestion on who we can bring. We'll talk about that offline, but
perfect.
um, I'd like to bring. And it's actually my CPA. He is super knowledgeable.
Good.
Um, you definitely have control over the value, like especially with multifamily. I think you have more control on the multifamily side of the value of the property. With single family homes, you have some control on like the amount of rehab and the quality of rehab you do, but you're still at the mercy of the other sold properties in your neighborhood. You
Yeah.
know, with multifamily properties, you have a lot more control over those, right?
Yeah. Yeah.
Yeah.
So
So, right,
this
improving
is
it.
I think of this as a slot machine, and in Houston especially, we're getting three cherries in a row. And the first cherry is these properties will cash flow. Like you can still buy cash flowing properties right now. Number two is that I don't think people realize if you put 25% down, that's a fourth of the value and it's appreciating by 4%.
Mhm.
That's a 16% return on your investment just with the appreciation. That's not even counting the amount of money that you're making in the with cash flow, and you're paying down the mortgage. But the third cherry, you hit it. That right there is the tax advantage, the bonus appreciation, the self-directed IRA, the deferred taxes. Like that's huge. And in most of the country, 2 out of 3 is a winner in most of the
Yeah.
country, you
Yeah.
know? So
Yeah.
so the tax advantages are huge, and then control over value, improving NOI, raising the
Mhm.
rents, improving it. That really increases the
Yeah.
value.
We can't sign off without going over the cons though. We
Okay.
have we have to go through the bad, right? So, I mean, whenever you're doing a rehab, you can go over budget super easy, right? You're opening up walls, you're finding wood rot, you're finding termites, you're finding all these things that you can't really see with a typical, professional inspection, right? So
Hmm.
your margins are going to be pretty tight.
Yeah.
And then your cash out, right? You're not necessarily getting all your cash back out, so you could end up leaving a lot of cash in those deals.
Yeah.
you know, we got trapped right in this the refi risk, right? That bullet point number one. Number two for us is the refi risk. We bought some properties at the end of 2021, refinanced them in the middle of 2022, and rates went up in May of
Yeah.
2022. They went up from 3% to 6%, like in less than a month.
Yeah.
And that really kind of threw a wrench in our plans, but right, we just stayed the course, held on, and we're still holding on.
Yeah.
You have that refi risk, because things can change if your project goes too long, right? You mentioned it at the beginning of the call is a lot of people were bailed out by, a really soft market that was
Hmm.
appreciating rapidly, right? Your project took a year and you made $100,000 in that
Yeah.
in that time, you know.
So you
Uh,
have to factor that in, that refi risk. And the
yeah,
way
you
and the
do.
way you do that, you just say, okay, worst case scenario, um, I have to hold on to it at this higher interest rate. What is
Yeah,
that going to look like? Am I going to cash flow even, or do I have,
yeah. Yeah.
for 12 months? Well,
Managing people, right? Contractors, renters, your lenders, all of those different processes and systems and things like that. I will say, like, the BRRRR strategy isn't necessarily built for beginners, you
right.
know, like it's built for people that either are partnering with someone or they have a mentor or coach that's getting them through this,
Yeah.
because there is a lot to learn when you're doing the BRRRR strategy, right?
You hit
And
the
then,
word you used was process. If you don't
yeah.
have a process, you're asking for trouble when it comes to managing your contractors, vetting tenants. You got to have a
Mhm.
good process for that.
Yeah, yeah. What else? Do you want to add anything else to that?
Market timing, we talked about that. So, uh, one thing I want everyone to take away is not just looking at the comps, but also looking at the trends, not just
Trends.
in your market as a whole, but in look at the macro and the micro as well, and look at you got to segment the trends differently. And we could probably do a whole show on studying and analyzing trends in the market because you may have a different trend line for 3 bedroom houses than you do for 4 bedroom houses. I mean,
Yeah,
obviously, we have different trend lines for multifamilies than you do for single families. So, um, the house, different school zones will have different trends, and so,
yeah,
and
yeah,
then you got your rental trends as well. So, I think trends is something that I'm really getting a lot better at looking at this year, and that's something I don't think many people are really paying attention to right now.
yeah, yeah. Yeah, and then the last thing you kind of hit on it before was, you're either going to partner with someone that has some cash, or you're definitely going to need some cash up front. Typically to get these projects started, when you're using a hard money lender, they typically want you to, make that first upfront payment to your contractors to get them started, and
Hmm.
then you start this draw process where you can, recoup that money at the end of the project. But yeah, having some cash up front or partner with someone who has cash up front, but it can be large sums of
Yeah,
money, depending on the size of the project, the size of the rehab. So, man, we
absolutely.
covered a lot today, bro.
Yeah, that was a lot. We can hit on it. So next week we're going to be talking about flipping versus buying and holding, how to decide, and maybe we can look at some more trends because it tells us a lot. It tells a story. The data tells a story, and so if you don't know the data, you're going into this blind.
Yeah.
Albert, my brother, I will see you soon. Don't
Awesome, man.
forget
I'll see you
Thursday
Thursday.
happy hour. We're going to be
Yeah.
at where are we going?
Jackie's.
Jackie's Brick
Jackie's.
House in Kima.
Yeah.
So come
I'll
out
be there.
Thursday, 4 to 7. Let me buy you a cold frosty beer, and
I'll take a Diet Coke.
I will. You get a Diet Coke
All
on the
right.
rocks. All right.
All right, buddy.
Bye, everybody.
See you, man.